We are live from the Reuters studio in Times Square in New York City. I'm ESG correspondent Isla Binnie, and this morning I'm joined by Rajith Sebastian, who is head of ESG and Sustainable Investing at the New York State Insurance Fund. The fund is one of the biggest workplace compensation carriers in the country, and Rajith's job is to manage on behalf of some 155,000 policyholders assets under management of around $20 billion in a way that is sustainable both for them and for the environment. Welcome, Rajith.
Hi, Isla. Thanks for inviting me, and hello to all the viewers.
So at this point, as we come later into New York Climate Week, we will be talking somewhat about Rajith's work. And I thought it would be good to start with, what do you think your responsibilities are as an asset owner, especially when it comes to the environment, and how do you integrate those responsibilities into the day-to-day management of your fund?
I mean, it's a great question and something that we think about quite a bit. You know, we're an asset owner. We're almost first in the chain from an investment perspective to a whole bunch of asset managers that are then channeling much valued investments into companies, projects, etc., globally. And so as an asset owner, what is our responsibility in a time where we're facing a climate crisis, where fiduciary duty gets challenged quite a bit, and when in a climate too, where asset managers are oftentimes pretending to have the impacts or the financial returns that we might want them to have, but sometimes not having that. So I think for us, we started off in 1914, so to speak, rose out of the ashes of a fire back then that was one of the biggest humanitarian disasters in New York City, the Triangle Shirt Waste Fire. And the Workers' Compensation Fund was formed as a result of that. We only started our climate initiatives a couple of years ago in 2022 when the governor announced that a mandate to do so. But that gave us an opportunity, being relatively late to the party, of having white space. You know, what do we create after the history of all the capital that's gone into ESG and climate to create something that we think would be both impactful but aligned with our fiduciary duty to policyholders. And so, you know, I would say as an asset owner, one of the things we think about is the principal agent problem. You know, when we're receiving pitch books, for example, from asset managers that are saying this renewables projects will have this much impact and this much financial returns, we have to step back and try and be pragmatic. Are these the impacts that we want to have? Is there evidence of these impacts? And in fact, is there evidence that you will achieve these risk-adjusted returns? So that's, I think, one of the big roles that an asset owner now needs to take, especially during the climate emergency. You asked a question about integrating, and that's certainly part of our approach too. We're not a big believer in this ESG metric or these climate metrics alone are to be focused on, mainly because there is confusing data, mixed data, a lot of kind of untransparency and ambiguity around the data. But the data is directionally correct, though. So we do think there's a lot to be said about using the data. But we think that an approach that integrates ESG data, climate data, as well as the end impacts, you know, how is this actually impacting our global climate? How is it actually affecting society? That's a much more pragmatic and balanced approach. We call that the NICE ESG lenses framework, because the way we think about it is, you know, if you're if you go to the optometrist and you're looking to see better, as we are in this cloud of climate issues and politics and a lot of ambiguous data, when we're looking to see clearly, why only use one lens? Let's put together a bunch of lenses that we know are material financially, like climate risk, like ESG risk, but also importantly, an area that we found has been neglected, the impacts on the real economy. Let's put those three lenses together and try and balance out a better view of what we should be doing in the space. So that's how we think about it from an asset owner perspective, and those are the types of themes that are top of mind for us.
This really is a fascinating and broad philosophy. One area that I'd quite like to bring out there is, you mentioned different kinds of duty. Fiduciary duty we talk about a lot, especially in asset management. And I wonder whether there is ever any tension between what you see as being your duties to the policyholders, to the environment, and whether there's ever any tension between those things, whether financially the impact that you're looking for financially, the impact that you're looking for environmentally, is there a balance to be struck there?
100% correct. I mean, you've hit the nail on the head. This is all about, I guess, balance here. There are often instances where certain impacts that we might look to have might not achieve the financial returns or our goals. And the other way around, areas where we might achieve better risk-adjusted returns, but we might be harming local communities, or we might have a net negative impact on the climate. So our role as an asset owner is to think through what over the long term, and remember our horizon is very long term. We need to think about 10 to 20-year horizons. A lot of asset managers that act on our behalf, coming back to the principal agent problem, might be acting on a 1 or 2 year bonus or carry or something else that incentivizes them. So that's a big piece of it. Over the long term, is there evidence of whatever's being promised achieving the long-term impacts and financial returns that we'd like to achieve? And this goes into conflict a lot. The part that we don't want to be at is not being able to pay out workers' compensation when somebody, a fireman or woman, gets injured at work. So that is critical to us. It's important that we have both lenses. And while there may be conflict at some points, there are instances where there's no conflict, and we believe that it could be a win-win, especially now where it's becoming increasingly clear that climate, ESG factors, and some of these impact factors, particularly around labor rights, worker rights, good jobs, there is more and more academic evidence that they do affect long-term financial performance. And so that's how we'd like to view it. We try and rely on the evidence that supports either the impact and or the financial returns, and we look for the best intersection there over the long term.
So you clearly do a lot of analysis and deep study of your own, but there are lots of asset managers who are competing to invest your capital for you. I'd be fascinated to know what you expect from them in this area. You've talked already to an extent about there being certain differences in terms of timelines. What do you expect from them? What questions are you asking them? And how satisfied have you been with their responses to your questions in the area of climate issues?
Yeah, I mean, again, a great question. It's been challenging with asset managers for us, and we've seen a lot of opportunities. So I will say you could clearly segment the entire landscape and think through who are some of the more intentional players that are very thoughtful about the space, and who might be less thoughtful and really looking to get another asset owner to invest in them. I mean, I'll be frank with you, there are often times in the market where asset managers will say to us, you know what, we used to think of you as dumb money. And other asset owners have told us they think of us as dumb money. And we believe that as as a fiduciary, as someone that's acting on behalf of oftentimes underserved populations like workers, even with pension funds, oftentimes the same thing that's often teachers, that we need to take a more active role in this space and really question asset managers as to what their motivations are, what their timeframes are. So back to your question about what are we looking for. I'll start off with what we're not looking for. What we're not looking for is flashy pitch decks. We get, and I'm sure other asset owners too, the best PowerPoint decks in the world are put in front of us in terms of these slides and these inputs that we provide will solve climate issues and will solve social issues, and therefore give us some money of that. that is a little bit off-putting when it's not accompanied by that these impacts could be achieved or these returns could be achieved. And we have to be pragmatic. There's not that much of a track record of climate or ESG solutions for us to definitively say these are the right types of funds. So what we prefer is a much more humble approach, a much more thoughtful approach, a much more evidence-based approach. I would say akin to how an analyst would think about a fundamental investment as opposed to marketing to us. I think that's one. You touched on the second, which is really time. So pitching us with solutions that are short-term versus long-term solutions, I think for us is a clear difference. And we'd like people or investors that are thinking much more about what are the long-term impacts and returns here. And then I guess linked to time is investors that also realize that there is a time value of impact here. As much as we want them to be thinking about the long term, we also want them to be telling us how they're acting now. And it might be just building up a team. It might be doing something else that's more humbling than saying this is the next greatest climate fund in the world. But there is the more time we spend not investing in ESG issues or social issues or climate issues, the more it seems, given the climate crises, social crises that we see globally, more systemic issues that we're seeing rise up, and that tipping point will adversely affect our long-term portfolio. So that's what we're looking to prevent. There is a time value of impact. So just like the time value of money, acting now will have a significantly bigger long-term impact. And conversely, not acting now would have a significantly larger negative impact. And so we'd like managers that are thinking through that with us. The final piece is a more integrated approach, like I mentioned earlier. So, pitching asset owners now with, here is the climate metric to focus on, and therefore we've decreased it, I think is relatively short-sighted, just given the data changes. The data is often 2 years old anyway. What we'd like more is more analysis into the climate risk more holistically, including the data, but also ESG factors that IFRS or ISSB publishes per industry, and finally the impact on the real economy, which includes your impacts on global climate as well as your impacts on lower income populations. And for us specifically, we like to focus on lower income workers, given the evidence of better rights, worker conditions, better pay leading to better profitability, and therefore for us over the long term, that's a key determinant of long-term financial returns. So I hope that somewhat answers the question.
No, certainly. And I think you mentioned the question of marketing is really quite interesting with all of this pitching that goes on, because of course you are in charge of a sort of a source of capital, and your decisions could potentially influence the eventual impact that's not only financial. We do hear a lot of buzzwords around sustainability. Do you have a way of sort of filtering through that? You mentioned the pitch decks. Are there certain kind of points that sort of raise red flags for you? Is it a lack of data, the kind of thing that you alluded to, or are there other signs that you might be seeing than you would like? And I wonder whether I can even introduce the word of whether you sometimes see the evidence of greenwashing.
Mm-hmm. Yeah, I mean, we've done informal surveys to try and assess what level of greenwashing both our managers are saying they might perceive within other managers, and also underlying investment companies and what they are seeing. From our perspective, there's a lot of marketing. In fact, I think one of the most unfortunate aspects of sustainable investing has been how much marketing of ESG and sustainability without evidence that we've kind of witnessed over the last few years. And perhaps that could be part of why there's been a backlash relatively recently. We haven't really, as an industry, substantiate why these factors do lead to these impacts. And oftentimes it is, the responsibility of us as asset owners to say, here is some of this evidence. Asset managers maybe take it on, but also of asset managers when they're pitching to us to say, these are the inputs that our funds will have, and these are what we think the outputs are. We're not looking for these will be the outputs. We think it's much better to be directionally there than 100% correct in this space. So just remind me, what was your...
Whether you have a particular kind of structure for trying to identify.
Assessing.
Exactly.
Yeah. So I mentioned a few things around not having evidence, but one of the other areas that's particularly troubling for us is when we ask about what about the emissions in the supply chain, for example, or any other sustainability related question, and the fund manager says, that's a great question, we'll bring our ESG person to answer that question or set up a separate call. Our thought process is these are material factors that affect our investments, and so as an asset manager or an investment manager working on our behalf, if you're not educated on some of these issues, how physical risk might affect your real estate holdings in a coastal region, or how better pay could affect your performance as a retailer, if you're not really thinking about the effects of these issues on your investments as the person making the investment decision. So to be very clear, this must be the investment manager making the decision. If you're not educated and you can't speak intelligently about that, you may not be investing our money responsibly. Just having a quote-unquote ESG person who might know the issues, but oftentimes we've seen has less of a voice in the investment decision-making, for us is a bit of a turnoff.
This is very interesting. Have you seen a change in recent years? I mean, you have been in this position for 2 years, two of the most arguably tense years for ESG, even as a term in this country. Have you seen a change amongst the managers or any of your other interlocutors in the financial sector around how they treat ESG as a function? Are you seeing more integration? Is there more investment in making sure that individuals who are directly doing investments take these things into account?
I think it's been mixed. I mean, with some of our managers, we absolutely have seen that transition where investment managers making the decision are more empowered to talk about some of these issues. However, there has been pullback with many of our asset managers where, sometimes nobody can talk about these issues, or we have to rebrand what we're calling it, or sustainability or responsible investing. That's fine as long as we're actually hitting on the issues. I think the challenge for us is many managers, at least over the last couple of years, have a step back, partially because of the political backlash, but I don't think it's just that. I think that it's partially because they don't see the incentive to make money out of the space, at least over the last 2 years, and therefore they would take some of their people that are more trained on ESG and say, it's not that much of an issue anymore, let's focus on another issue where we can raise funding, like artificial intelligence. So we have seen that shift too. Again, I think it's important as asset owners to be very discerning with asset managers, because it is our responsibility. We're the first funnel or channel of capital a lot of the times into the entire pipeline that gets to climate solutions or social solutions. And as a result, we really need to think through who's thinking about this intentionally, who's focused on long-term outcomes, and then who's really just looking for a quick buck.
And those long-term outcomes, I mean, we've talked a bit about data and about your processes for assessing the opportunities that are available to you. How can you measure success in these outcomes? You've talked about impact. I'd be interested to sort of draw a little bit more of that out. How can you measure that, and where are the challenges in measuring it?
Right. So our NICEF ESG lenses framework is 3 buckets. These include climate risk, ESG risk, and the impact on the real economy. The first 2 are pretty traditional right now. So With our climate risk, we're able to look at physical risk, transition risk, and emissions. And those, from various data providers, we're able to get a sense of that. So that is, for us, the data is out there. On ESG risk, we look at the factors that might be material. ISSB or SASB is pretty good at pointing out some of those that might be industry specific. Again, we measure some of those. But for both of those, again, climate data is 1 to 2 years old, oftentimes 2 years old. It's not, it depends on the company's disclosure. Disclosure is very varied. And so, and ESG data, similar issues. So for both of those, we look directionally as to, we dig deeper than just the data. We look at what are the actions the company or the industry, what are the actions the company is taking that will transition them in a certain direction. And we look to be directionally right about, whether they will achieve what they're saying they will achieve. The final part, the impact on the real economy, we think is really interesting. This is, for us, two aspects. One is, what is the impact beyond on our own portfolio on climate? And the second is, what is the impact on lower income workers? So let's go to the impact beyond our portfolio. If, for example, we divest of all our fossil fuel producers in our portfolio, I think that would reduce our emissions immediately. And so we'd look good in that initial bucket that I mentioned, climate risk. We'd probably reduce our climate risk. But what would we be doing about global emissions? If, for example, a private company comes and buys up, sees the opportunity, it looks like now everybody's divesting of fossil fuel producers, let's buy them. We do have energy needs. And actually takes lesser care of these companies, becomes even browner in terms of their emissions, we've had net negative impact on global emissions. And so that's something we're very thoughtful about and becomes part of our engagement. Mm-hmm. On work, and there's a lot of evidence of those externalities, either from legal cases or reputational risks that could come back and hurt us over the long term. On workers, same thing. A lot of academic evidence, though I will admit this is all relatively new because this has been an understudied area in investing. A lot of evidence that good jobs, workers' rights, does lead, better maternity pay. All of these issues does lead to higher productivity. And therefore, higher productivity, better financial returns. And for us as a long-term player, it reduces our risk, strikes, all kinds of other negative impacts of treating lower income workers badly, and so reduces the risk and improves our financial returns over the long term. And so that's the area, the third piece, the impact on the real economy, that's the newer area that we're looking at. When we think about it from an ESG lenses perspective, that almost brings in an impact investing angle into a traditional ESG and climate framework. And then when you think about different asset classes, easier to apply that for alternatives where some of that information you can talk directly, much more tricky in an ETF. And so for an ETF, we'll rely on where we can find the data that is directional. We might rely more on the first two buckets than the last. But for every investment at NYSIF, we do consider all of those three lenses.
It's very interesting to think about the difference between the alternatives as well, because I can imagine that the ESG ratings that are available perhaps are less applicable in the alternative space. I don't know how much reliance you would place on the kind of mainstream available ESG ratings. But
we look at all the ratings. We think the ratings are all great. They're all oftentimes mixed, but that's because of their different methodologies. So what we have our team do is dig into the writing or the text, the subtext behind the ratings to understand what are the material factors. But oftentimes we do our own analysis. We don't rely only on ratings.
Do you consider yourselves to be unusual in that respect, given the size of the fund? Because, of course, we have vast pension funds that have a lot of these capabilities in-house. I mean, apart from anything else, your net zero plan is, as you mentioned, relatively recent, from 2022. Can you give us an idea of what's changed since you kind of made that set that net zero strategy, and what you've actually set up in that time?
Yes, since we announced the goals, one of the first things we did was look at our portfolio and think through where are the quick wins here. Because in this space, these challenges are they're systemic, they're big challenges. You could sit back as an asset owner and think, oh my gosh, how am I going to solve anything here? So low-hanging fruit for us was how do we reduce our emissions quickly? And there was one sector where we saw a correlation, it would both reduce our emissions and potentially lead to better long-term financial returns, and that was the coal mining sector. So one of the first things we did was a very stringent screen against anything that was, any companies, any managers that had more than 1% in revenue from coal mining. That immediately reduced our carbon exposure in the equity portfolio by something like 40%. So immediately. And it was also impactful because we seeded a fund. So we can, a new fund, Calvert was looking at a new response, a few ETFs that actually met our carbon goals, our coal goals, as well as the engagement goals that we had with workers. And so we seeded them. At the point we seeded them, we got a lot of backlash internally because we were something like 95% of that ETF. Over time, we've come down to about 50%, and we didn't even publicize it because we thought, let's do this. It's impactful. Let's get that out there. But that's one of the first things we did. On the bond side, we continue to invest in bonds that are green. Again, a lot of things about the taxonomy of green bonds. So we have to dig deeper than what comes out of the taxonomy and think through, are these the outcomes that we'd like? And so our green bond portfolio is now $300 million larger than what it was when we started. Alternatives has been where we've leaned in quite a bit. And so investments in sustainable infrastructure has been a huge area of focus for us. In addition to that, we've really been thoughtful about private debt as an asset class and what are the levers, even in investing in something that is somewhat disconnected from the end equity outcome. What can private debt investors do to influence the space when they provide lending out there? So that's another space which we've levered. And then, of course, private equity and real estate are areas that we've looked at. But alternatives has been the main area of focus for us over the last couple of years.
It's fascinating, of course, because of your quite unique profile gives you the opportunity to do all of these different things. We are coming up towards the end of time. We could talk so much more about all of these things. I would like, if possible, it's probably not a very fair question, but of all of those investment opportunities that you were just mentioning, all of those areas, is there one that you feel particularly kind of optimistic about for the coming year? Are any of those spaces showing any particular growth in any way that you find kind of that may have changed in recently?
I think the sustainable infrastructure space is really interesting, especially with the tailwinds from the IRA. And that's an area that we think will continue to grow. The specific area there that I think is really interesting where we could have a material and differentiated impact is around the infrastructure powering artificial intelligence. So cooling, energy, all of that is going to increase the use of our grid by 10%. And so where will that come from? I think that could be but there are opportunities there for renewable energy to step in. And not just that, we should be more mindful about how we can mitigate some of that and potentially use artificial intelligence to think more efficiently about creative solutions. So that's an area of strong interest for us.
And that would bring together lots of big players across the industries. So that would
we think so.
Yeah, that would be that's fascinating. Well, I thank you very much for your time on all of these topics. It's been absolutely fascinating to hear from you. I'm sure it's given lots of people lots of different ideas today, and I hope that you enjoy the rest of your Climate Week in New York.
Thank you, Isla.
Thank you.
Thank you.